Picture this. The tax department literally shows up at your client's business to initiate a search. It is an incredibly high-stress situation, right? But what exactly happens next from a legal standpoint? How does the department actually calculate the tax owed under the brand new laws? And what are your exact rights? Well, let's dive into it.
Welcome to this explainer. Today, we're unpacking a really critical framework under the newly modernized Income Tax Act, 2025. Specifically, we're zeroing in on Chapter 16B. That's the special procedure for assessment in search cases, covering Sections 292 right through 301. Look, if you're a chartered accountant, a tax pro, a CA student, or a business owner, mastering this modernized legal framework is absolutely essential for your practice and, honestly, your peace of mind.
Here is our quick roadmap for today. First, an introduction to search assessments. Second, decoding the legal provisions. Third, a practical case study. Fourth, compliance and precautions. Fifth, common mistakes to avoid. And finally, our summary and key takeaways.
All right, let's kick things off with Part 1, Introduction to Search Assessments.
So, at its core, Chapter 16B of the new 2025 Act is designed to do one very specific thing: provide a dedicated, specialized procedure for assessing undisclosed income found during a search. But, and this is an absolutely crucial catch, so pay attention, this new framework strictly applies to searches initiated on or after April 1st, 2026. If a search happens before this date, it's still completely governed by the old 1961 Act, thanks to the transitional provisions in Section 536.
Moving right along to Part 2, Decoding the Legal Provision. Let's deconstruct this complex statutory framework into some easily digestible pieces. The absolute cornerstone of this whole framework is the concept of the block period, which is defined under Section 301. See, when a search happens, the assessing officer doesn't just look at a single financial year in isolation. No. Instead, they look at a specific consolidated block of time. This block is legally defined as the aggregate of the 6 preceding tax years, plus what we call the broken period of the current tax year, right up to the very date the search is actually executed. To put that timeline into perspective, think of it like this. You start with the 6 full tax years immediately preceding the search. Then you add in the time from April 1st of the current tax year right up to the exact date the search is executed. Everything captured within that specific window forms your statutory block period for assessing any undisclosed income. It's the whole shebang.
So, what actually happens to ongoing, regular tax assessments when a search hits? Section 292 lays out the mechanics pretty clearly. First, the search is initiated. Then, the assessing officer assumes jurisdiction to assess the total undisclosed income for that entire block period we just talked about. And here's the kicker. This is vital to understand. All pending assessment proceedings for any tax years falling within that block period immediately abate. They effectively just pause and merge right into this new, comprehensive search assessment.
Okay, but how is the actual tax liability calculated? Well, under Section 294, the computation is laser-focused on hidden income. The officer identifies income based purely on unrecorded entries, assets, or documents found during the search. Then, they deduct any income that the taxpayer had already properly recorded in their normal books of account before the search even happened. What's left over? That is determined as your final, total undisclosed income, which is then subject to the special tax rates.
Now you might be wondering, what if the tax department finds assets or documents that belong to someone else entirely? This is where we look at the exception under Section 295, handling other persons. If seized assets belong to a third party, not the person actively being searched, the assessing officer actually cannot assess them there. They must physically hand those assets and documents over to the specific assessing officer who has jurisdiction over that third party. That third party will then face their own separate assessment based on those materials.
Let's see this in action with Part 3, a practical case study.
Let's break down how these income streams are actually separated. Imagine a business gets searched during tax year 2027-28. The AO looks back at the block period. Let's say for tax year 2026-27, their books show a properly recorded business income of 50 lakh rupees. But during the search, the department discovers unrecorded cash of 20 lakh rupees linked to that exact same year. The AO is going to tax the 50 lakh under normal, standard provisions. However, that 20 lakh of unrecorded cash, that gets pulled out and taxed specifically as undisclosed income under the Chapter VIB block assessment.
All right, let's pivot to Part 4, compliance, and precautions. Because for tax practitioners and business owners, understanding the law is only half the battle, right? Proactive compliance is the rest of it.
And this brings us to a massive legal hurdle. Under Section 524 of the new Act, any assets, books, or digital information found in your possession during a search are legally presumed to belong to you, and their contents presumed to be true. The burden of proof is sitting entirely on your shoulders. So, to protect your clients, you absolutely must maintain rigorous, real-time books of account. Ensure electronic audit trails are active and fully compliant with the Income Tax Rules 2026. Honest, transparent compliance is quite literally your best defense here.
Which naturally leads us to Part 5, Common Mistakes to Avoid. Let's look at the procedural pitfalls that are definitely going to trip up practitioners during this transition.
A major point of confusion, and this is explicitly addressed in the department's FAQs, by the way, is terminology. The old 1961 Act used previous year for the year the income was earned and assessment year for the year it was actually taxed. The Income Tax Act 2025 simplifies all of this into a single unified tax year. For instance, the income of financial year 2026-27 is now simply assessed as tax year 2026-27. Using the old term assessment year in any post-April 2026 filings is going to lead to immediate procedural errors, so definitely watch out for that.
Another absolutely critical mistake is mixing up the legal regimes. Look, if a search is initiated before April 1, 2026, it is governed entirely by the old ITA 1961 provisions. No exceptions. But if the search is initiated on or after April 1, 2026, it is governed strictly by the ITA 2025, sections 292 to 301. The exact date the search is initiated completely dictates which act applies. There's no missing year, and there is zero overlap.
Let's wrap things up with Part 6, Summary and Key Takeaways.
Here are the core lessons you really need to take away from this explainer today. 1. Chapter 16B applies exclusively to searches initiated on or after April 1, 2026. 2. The block period covers 6 past tax years plus the current broken year right up to the search date. 3. Any pending assessments automatically abate and merge into the block assessment the moment a search is initiated. And 4. Update your vocabulary. The new Act universally uses the term tax year, completely throwing out that old assessment year confusion.
As we transition into this modernized era of taxation, the ultimate question you have to ask yourself is this: are your clients' internal audit trails truly ready for the strict scrutiny of a 2026 block assessment? The time to prepare is absolutely right now. Thank you for watching. Please like, subscribe, and share. Disclaimer: this video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.